Well, we had an exciting day yesterday. Google reported huge blowout earnings. They beat all of their expectations. Not only that, but Google let us know that their stock price is approaching $3,000 a share now, and they're going to be doing a 20-for-1 stock split. This is the biggest stock split I think I've ever seen. And based on recent history, stock splits do affect the stock price to some degree. So I'll be sharing my thoughts on that. Facebook, on the other hand, is plunging. It's down over 20% after hours on weak earnings and a big forecasting miss. So the stock price is moving around right now, but it's jumping between 20 and 21% in the red as of now. We also had Starbucks' earnings. This is a company I just purchased into, and it was a mixed results. There were some good things, there were some bad things. I'm going to go over the results in this video. Another big company that had a horrible result is PayPal. PayPal had okay earnings of last quarter, but investors don't just look at last quarter. You're investing for the future. And PayPal shared some of the weakest guidance we've seen in a major company. PayPal shares are in free fall. They're down 25% just today, and that's after a steady decline in stock price for the better part of a year. Not too long ago, PayPal was up to $308 a share. Now it's at $130. So we're going to be talking about PayPal as well in this video. So welcome back, everyone. We have a lot to jump into in this episode, a lot of exciting news to talk about and earnings reports to go over. Now, if you're new here, this is my passive income portfolio. It's real money, $357,000, $64,800 in gains currently. This is a portfolio that I track week by week live every single week on this channel. So if you want to follow along and see how a real portfolio turns out, you can do so by subscribing to the channel and following along for free. Now, my tech and cloud computing category, I don't currently have Google in this portfolio, even though I think Google's one of the best companies in the world. The reason why is because Google's in my growth portfolio. So I do have a significant holding in Google, but I track that on my second YouTube channel. Google just reported their fourth quarter earnings, and it was pretty incredible. Let's go ahead and take a look at them. They beat on their earnings per share by a wide margin. They also beat on their revenue expectations by a wide margin. They brought in $75 billion of revenue last quarter. YouTube was actually the biggest disappointment of the company. Imagine that. As great of an asset YouTube is, this was the disappointing factor of Google. It only brought in $8.63 billion instead of the $8.87 billion expected. So YouTube missed by a little, but in my opinion, that's not too shabby of a performance. That's higher revenue than what Netflix brings in. So YouTube is now bigger than Netflix. The cloud business is something that every investor loves. Google Cloud brought in $5.54 billion last quarter, beating expectations. Google Cloud is the third biggest cloud provider in the world. You have Amazon AWS in a clear lead in first place. Amazon is way bigger than Google Cloud. Then we have Microsoft Azure behind Amazon. Then we have Google Cloud. Amazon, Microsoft, and Google are the three cloud kings, and then it's divided up between a bunch of smaller companies after them. Now, Google's advertising revenue, which is the majority of their revenue, climbed 33% year over year from $46.2 billion to $61.24 billion. Advertisers spent a lot more money this year. That is a significant increase. So overall, Google investors are very happy today. Their company's doing fantastic. It's been one of the best companies to invest in over the past year. Since 2020, Google has basically been a layup. This company has just been the easiest company to invest in. It went up 58% from the 2020 lows to 2021. Then it's up another roughly 70% in 2021. Just today, the company's up 8.2%, bringing that stock price right back to that $3,000 a share. Now, a lot of new investors may look at Google and think the company's expensive. The stock price has soared over the past year, going up 54%. That may lead you to believe that it's expensive, and the stock price is $3,000 a share, which is a lot higher of a number than most stocks. But Google is not an expensive company, not by any real measure. In fact, the forward PE ratio is currently 23, maybe around 24 now after today. This is a very low forward PE for a company of this caliber. It's barely above the S&P 500. And the psychological barrier of buying a $3,000 per share price is soon going to change. They also announced that they're going to be doing a 20-for-1 stock split. That means that every single share of Google will be divided by 20. They'll be broken up into 20 shares. You'll still own the exact same amount of the company, but now the share price will be $150, and you'll have 20 times as much. That's all this means. This is mostly a cosmetic change, but I do think it has a real impact on the stock price. You might think that you're above the psychological barrier of Google's price being $3,000 a share. You might say, well, that doesn't really affect me. I look at just the PE ratios and the fundamentals, and that may be true for some of you, but think about this for a minute. Just imagine that we go bing and we plug in the new share price of Google. It's now $150 to pick up a share. $150. That's a lot more bite-sized. You could pick up a couple shares. You get your paycheck, you get $600, $700 of discretionary investable money, and now Google's one of the companies that you might pick up a couple shares of, when before you'd have to save up $3,000 to buy a share. Even in modern day America, $3,000 is still a lot of money. So having it be $150 a share, if anything, it makes it a little bit more liquid. More people have access to Google. The bar of entry is literally 20 times less. So even though this doesn't change important metrics of the company, like the revenue or EBITDA or profitability, you can't just split your shares more and more, hoping that the company does better, but it does make the company a little bit more bite-sized. You can invest in it more incrementally. It'll also change one graph on the fundamentals of Google. That is the shares outstanding. Because they're doing a 20-for-1 stock split, there's now going to be 20 times as many shares outstanding. So next quarter, you're going to see this graph spike up 20 times. That's not because they're diluting you. They're not just issuing new shares, they're chopping the current ones into 20 slices. Now again, this doesn't affect the income, the debt, the balance sheet, or anything like that, but as we've seen with other companies like Tesla and Apple, this only seems to have a positive effect. I don't think stock splits are ever really seen as a bad thing. Now I want to highlight one trend going on with Google, and this is using Qualtrim Insights. This website and tool is available at no additional charge as part of the Patreon. You can try it out for free. There's a link in the description of this video. But let's go ahead and pull up the earnings per share chart. This is the EPS of Google over time. You can see way back in 2014, they're earning $10 and then it bounced around $7, $8, $9. This is quarterly. So every quarter they're earning around $9 to $10 for years. It was going up slightly over time. There was some gradual EPS gains, but look what happened in 2020. It went down for a while as advertisers pulled their money, but then it spiked back up in one quarter. I remember when this happened with my advertising revenue. I could see that Google was probably a good buy because all of a sudden the advertising revenue started to spike up for my videos. You could see this happen across the board. Advertisers put more money on Google as time went on. The company went up to $22 per share in quarter 2 of 2021. That's a lot of money per share. That's double what they were doing just a few years ago. $9 per share, now $22 per share per quarter. But then another gargantuan spike up to $26, $27, $28, $30. This is incredible. $30 a share now per quarter when just a couple years ago they were earning $13 a share, $12 a share. They've literally tripled the amount of earnings per share over the course of a few years. So Google's on a roll right now, beating expectations and continually growing their earnings much faster than analysts expect. The question we have to ask ourselves is this sustainable? Are they going to continue to do this? Or is all the future growth accurately being priced in? In my opinion, when I look at this stock and the fact that it's trading somewhere in the mid-20s PE ratio, I don't think all the growth of Google's priced in. I think this company's still undervalued. They are going to continue growing. That's my assessment of the company. And likely they're going to continue growing faster than analysts anticipate. The biggest risk for Google is the same risk for many companies. It's a recession. If we go into a big recession, the revenues will not grow as fast because advertisers will pull their dollars. That's the biggest risk. So even though there's a risk of recession, I think that's a risk that most other companies have. All things said, right now, even after this recent price bump, I still consider Google one of the best value companies in the market. Facebook obviously did not do this. Facebook's earnings per share were $3.67 versus $3.84 expected. So they missed on their earnings per share and then they slightly beat on their revenue, $33.67 billion versus $33.4. That's not a great quarter for Facebook. Not only that, Facebook has their restructuring going on, they're changing their name to Meta, and they're also expected to be spending around $3 billion per quarter on their Reality Labs. That is a huge expense. That's free cash flow money going back into this Reality Labs, and I don't think so far all investors are on board with this new endeavor. I think a lot of them view this as a lot of money being used for something that may not have the best returns. Now, for me personally, Facebook seems like an undervalued company on paper, but I'm one of those investors that I'm not fully on board with them spending huge amounts of money on Meta and on this new opportunity. I think that they're going to face a ton of competition in this field, and it's going to be a long road until it's really profitable. Right now, Facebook's PE ratio is 20.4, and that's going to go down after this new price drop is factored in. I know a lot of value investors love Facebook as a company. They think it's a great investment, but this is one that I'm just not sold on. Let's go ahead and look at another company in my portfolio, which I just added a week ago, which is Starbucks. I purchased $25,000 of this company. Now, I bought the company like a week before their earnings results, which a lot of people thought was really risky. But I wasn't too concerned about it. I bought the company at what I consider to be a pretty attractive price of a very high quality company. Starbucks posted mixed results, meaning their earnings per share was a miss. They were expecting 80 cents a share. They only got 72. So they missed on their EPS, but they exceeded their revenue expectations. Now, what this means when you beat on revenue, but you miss on your earnings, there were some expenses in the business that lowered your margins. And that's exactly what happened with Starbucks. The company cited numerous issues going on, higher than expected costs throughout the supply chain. We have more employees using sick leave. That's another big issue. Lots of people are getting sick with Omicron. Now, overall, global same-store sales grew by 13%, but the company's growth is being hampered currently by China. China's same-store sales shrank by 14%. They were a major detractor from the overall growth of the company. And the CEO of Starbucks explains what's going on with China, what their strategy is, and the problems that they're currently facing.
Yeah, clearly every market around the world, governments are figuring out how they want to navigate this pandemic. And in China, they have a zero COVID policy. So if they have some number of citizens in a city that test positive for COVID, they shut down the entire city for a period and they test everyone so that they can identify, who has COVID, and they can then quarantine those people, and then they reopen the city. So there's constant waves of store closures and constraints created by that.
So China has a much more strict policy on COVID than we do in the US, and those lockdowns are affecting performance. But he also goes on explaining how this really isn't indicative of how stores will perform in the future.
But when you look at our stores in China, clearly international travel is really, really low right now. So our stores that are in airports and the international travel terminals are closed. And so that's weighing on comp. Stores that are in office districts are much slower than they used to be. But when you look at stores that are in residential or commercial zones, they are performing very well. They're comping positive. And more importantly, when we open a new store in China, it is performing at some of the highest in unit volumes and return on invested capital of any of the prior classes of stores we've built. So we're leaning in. We're building roughly 700 net new stores a year in China. They're performing extremely well. And at some point, as this pandemic subsides and we go back to more normal cadence of living, we're going to be well positioned in China, and there is a long runway of growth opportunity ahead for Starbucks.
So travel's still being restricted. Lots of stores are still closed, but the ones that are open are performing really well. And I like that this management continues to be aggressive. They are leaning into this. They're building an additional net 700 stores. And I know that most investors look at the earnings per share, they look at the revenue growth, they look at the store openings. One of the key metrics I think we have to pay attention to if you're an investor in Starbucks is the app, the rewards program. Remember, this is their phantom bank. This is how they get access to billions of dollars of their customers' money at a 0% interest rate. The active 90-day users for its Starbucks rewards program rose 21% to 26.4 million people. And the use of their app growing this quickly, I think, is a great thing. Now, another huge quality of Starbucks that differentiates it from a lot of other companies is pricing power. That's what you want in an inflationary environment. When expenses start to stack up from employee issues, from input costs, the big thing you want is a company that can raise prices. Starbucks CEO Kevin Johnson said on the company's earnings call, he is anticipating higher inflation for the rest of the year. I think that's a pretty safe assumption to make. Likewise, supply chain issues are also expected to be an issue. As a result, Starbucks is planning more price hikes after already raising prices in October and in January. So this company can raise prices seemingly as much as they want. And they know if this works or not. You may think, well, they can't keep raising prices. Surely people will go somewhere else. They won't just keep paying. They know. They do tests, they do analysis on it, they know what their customers are willing to pay, and they're going to raise prices to compensate for inflation and input costs. This is the sign of a high-quality business, the ability to constantly raise prices to offset expenses. So I'm not going to spend any more time talking about Starbucks and their fundamentals. Everything is moving in the right direction. I still think the company's attractively priced and has a very long-term growth story. Now, moving on from Starbucks, let's jump into PayPal. PayPal had a disastrous earnings report. And this is a company that I don't have much exposure to. In my growth portfolio, I have like $200 in it, so it's really not a lot. I used to invest in PayPal. It ran up so high that I locked in some gains, and I largely closed out my position. PayPal is a company that I view as a very strong company with a very compelling offering for its users. And these results are a little bit shocking to me. I have to be honest here. I was expecting a pretty strong result from PayPal, but these results, I think, of course, were also shocking to all of their shareholders. The stock is currently 25% down on the day, just today. This is one of the biggest single-day sell-offs that I've seen. This even beats Netflix. Netflix had a poor outlook, and so it dropped 20%, but this is almost 26% in the following day. And this doesn't come after some huge run-up. In fact, PayPal has been on a downtrend for months now. Now it's down 57%. This is a massive change of story, change of narrative for PayPal. So let's go ahead and dive into what exactly went wrong. Let's first look at the performance of the recent quarter. This was Q4 of 2021. They say that they earned $1.11 versus $1.12 expected, so they barely missed earnings by 1 penny, not a big deal, and they beat on their revenue, $6.92 billion versus $6.87 billion expected. So they barely missed on their earnings. That's not something investors are going to fret about, and they beat on their revenue. This sounds somewhat similar to Starbucks. So why did PayPal sell down 25%, but Starbucks stayed flat? All of this has to do with future expectations. Last quarter's results are just that. They're last quarters. Investors are buying companies for the future. PayPal now trades at a 29 PE ratio, but just recently was trading at a 40 plus. It was being priced as a hyper growth company, a company that's going to grow its revenue and earnings dramatically, much faster than companies trading in the mid-20s. And that's where the problems came in. The company expects first quarter non-GAAP earnings per share of 87 cents, short of the $1.16 anticipated by analysts. That is a huge gap between what the analysts were expecting for future growth and what PayPal is now projecting. And PayPal also said they're forecasting revenue growth of 15 to 17%, while the analysts were expecting a number closer to 18%. So both of the earnings and revenue growth are far below analysts' expectations, and this is something you simply can't do in today's current market environment. You can't be priced as a growth company and give lowered future guidance. You can't say that you're now growing 15 to 17% in line with a lot of conservative, low-priced dividend companies and be priced at the price that PayPal was, with a 40 plus forward PE ratio. The market will instantly and dramatically re-rate the company, just like they have with many others. Now, PayPal's facing a lot more issues than I previously anticipated they would. Listen to the CEO explain all the different things that they're dealing with right now.
On guidance, they're taking what he called a measured approach to guidance for the year. Talked about that eBay transition. That's been a big focus of this report. They are still working through that. He says the transition is hiding some of the underlying strength of PayPal's business. For example, that 13% revenue growth number in the quarter, he says, would have been 22% revenue growth if you strip out eBay. Not just eBay, though, guys, on guidance. Schulman mentioning some external factors, exogenous factors, he called them, like inflation, impacting some of the spending and segments in their user base. Supply chain also disproportionately impacting cross-border, especially coming from China and some of his small business merchants on the PayPal network.
So they bring up eBay, supply chains, inflation. All these type of things are affecting PayPal. And you'd think that this company is a little bit more removed from those issues than other companies. But it seems like they're facing a lot of the similar types of issues that companies like Starbucks are, but they're priced at a much more aggressive price. Now, we also see all the analysts pile on and start to downgrade this stock. BTIG analysts, who downgraded their stock to neutral and removed the 270 price target, said in a note on Tuesday that PayPal is now a, quote, show me story. They cited new areas of uncertainty, including significant shift in the company's approach to customer acquisition and engagement. They also pointed to the company's comments that the full-year forecast was cautious, due in part to inflation and supply chain issues, which the analyst said, quote, offered a sharp contrast with the more upbeat annual outlooks offered by the big card networks, Visa and MasterCard. So basically, the analysts are saying here, why is PayPal citing all these supply chain issues and inflation when Visa and MasterCard don't seem to be having that as a real issue? They're far more upbeat about the future than PayPal. And I agree with the analysts here. Why is there this big discrepancy between the card networks and PayPal? They virtually run the same business. They're processing payments. Why is one of them being more affected than the other? Regardless, if you're a PayPal investor, the company outlook doesn't look fantastic anymore. They have lots of issues they're facing, and you're most likely deep in the red on this one. The first thing that I would mention to any PayPal investor is, first of all, not be too concerned about getting one choice wrong. There's a lot of super investors that do this full time, and they have research teams working on these companies, and they were heavily invested in PayPal. Lindsay Train had 14% of his portfolio in the company. Pat Dorsey, a very knowledgeable investor, he did the entire moat rating for Morningstar. He had 13% of his portfolio in PayPal. Terry Smith, the one that focuses on return of capital and high quality companies, had 8.84% of his portfolio in PayPal. This was his second largest holding. Lots of good investors have taken a hit with this company. While PayPal's stock price was flying higher and higher, the earnings per share were staying pretty flat. They haven't moved that much for the last 5 or 6 quarters. PayPal's stock price flew way above its earnings per share, and now it's coming back down closer to it. Now in my portfolio, I exited all of my payment processing positions. In my fintech and banking category, I used to have Visa and MasterCard. There used to be 2 companies in my portfolio. I decided to sell them off and put that money in companies like Microsoft because I realized I didn't really understand payment processes as much as I liked. And I looked at it as a field that is just growing in competition. I see so many different options to move money around. You got your normal payment methods on different websites like Shopify, but then you have Amazon Pay, you have Apple Pay, you have PayPal, Venmo, Cash App, Facebook Pay, so on and so forth. Every one of these companies are making their own type of digital payment platform. Even Shopify is making their own very specific payment platform. And I viewed this as becoming very convoluted, not knowing who's going to win out with this battle. And it almost seems like it's now becoming commoditized. Like every major tech company can create a payment platform. So when I don't feel like a company is a home run and very easy to understand, I sell it and move on to companies I do think are home runs and very easy to understand. So this is a tough situation to be in as a PayPal investor. If you bought it anywhere in the past year, you're heavily in the red, and even anywhere in the end of 2020. It's already back to the price it was early 2020. That is an incredible fall. So like I said before, I think payment processing is a very difficult industry. It's difficult to understand, so I'm going to be focusing my efforts elsewhere. So that's my update for today. I hope you enjoyed me covering these 3 companies and their earnings reports. If you like these type of videos, let me know. I may do more of them in the future as more companies report their earnings. But that's my portfolio. That's the update. I'll see you in the next episode.